So hello all my dear students, I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So capital gain revision we were doing in the last session. We have completed more than 50% of the capital gains revision in the last session. So let's continue with the next part, and the next part is under section 47 itself, that is 47.18 and 47.19. What is this 47.18 and 47.19? It's a consolidation of certain mutual fund schemes and mutual fund plans. A mutual fund company is there. Under that there are a lot of schemes like HDFC Mutual Fund, FMCG scheme, HDFC, you can say blue chip scheme, you can say HDFC mid cap scheme. There are three schemes under HDFC. Now the government says that you have to merge them, you have to consolidate them. The one which is closing will be called as consolidating scheme, and the one in which they are getting merged will be called as consolidated scheme. It is just like amalgamation. Amalgamating company, amalgamated company. Same way, consolidating scheme is the closing scheme. Consolidated scheme is the scheme in which they are getting merged. So what will happen in this case? If I am a unit holder of consolidating scheme, if I am a unit holder of consolidating scheme, I have to do only one thing: give the units of the consolidating scheme back and take the units of the consolidated scheme. And if I do that, my capital gains is exempt. What will happen in future when I will sell the units, new units? The new units which I will sell, the cost of acquisition of the new units will be same as the cost of acquisition of the consolidating scheme units. The period of holding will also be clubbed. This is given under section 47.18. Similarly, there is one 47.19. What is there? 47.19, which talks about consolidation of plans of mutual fund. It is exactly same like schemes of mutual fund. Just the difference is within scheme there are a lot of plans. Like in HDFC mid-cap fund, there will be three types of plan. One will be called as growth plan, one will be called as dividend reinvestment plan, one will be called as dividend plan. So if there is a merger of these plans, then that is also exempt under section 47.19. Similar provision, same provision. Consolidating plan, consolidated plan, merge, give back the units of consolidating plan, take the units in consolidated plan. In future, if you sell the units, the cost will be same as the cost of the previous plan. Period of holding will be clubbed. So this is what it is given in this particular discussion. Now let's move on to the next part of section 47.7AA. Pay attention please all of you. What is 47.7AA? There is a non-resident outside India who is transferring to another non-resident outside India. Rupee denominated bond. What is it transferring? NR is transferring to NR rupee denominated bond, which is issued outside India, and that rupee denominated bond belongs to Indian company. In such case, capital gains is exempt. You can check it over here. Capital gains is exempt. So if an NR transfers to NR outside India, rupee denominated bond of an Indian company, it is exempt under section 47.7AA. What will happen if that same NR transfers the units back to the Indian company on maturity or on redemption? Then it is not exempt. Only if an NR transfers to NR, then it is exempt. If that particular NR gives back the bonds back to the Indian company on maturity or redemption, then it is taxable. Now, when it should be taxable? Suppose the bonds are issued for 1 lakh and it is redeemed for 1,10,000, then the difference should be 10,000, should be taxable definitely. But sometimes what happens? The bonds are issued for 1 lakh and it is redeemed for 1 lakh, still it is getting taxable. Sir, how sir? Issue value is 1 lakh, redemption value is 1 lakh, purchase cost is 1 lakh, sale cost is 1 lakh, sale price is 1 lakh. How capital gains will be chargeable? Because of appreciation of rupee. Suppose today $1 is equal to 100 rupees, and the non-resident wants to invest in India 1 lakh rupees. How many dollars he needs? He needs $1 lakh. $1 lakh, $1 100 rupees, $1 lakh $1,000. $1,000 will be equal to 1 lakh rupees. So today he bought 1 lakh rupees bond by giving $1,000. Now after 10 years, suppose the rupee appreciate. If the rupee appreciate and it becomes $1 is equal to 50 rupees, for example, then on redemption also he will receive 1 lakh rupees only. But when he will convert now 1 lakh rupees into dollar, it will become $2,000. So at the time of redemption, the dollars are 2,000. At the time of purchase, the dollars are 1,000. There is a gain of $1,000. So if the appreciation of rupee is the cause for the gain, the cause for the gain is appreciation of rupee, then that much gain will be exempted under section proviso to section 48. So if there is a real gain, if the issue value is 1 lakh and redemption value is 1,10,000, then 100% capital gains will be chargeable. But if the issue value is 1 lakh, redemption value is also 1 lakh, but because of appreciation of rupee, if there is a gain coming, then that gain will not be subject to tax as per proviso to section 48. And if NR gives to NR outside India, then so it is absolutely exempt. I hope it is clear to all of you. Now, some non-resident taxation provisions, some few more non-resident taxation provisions are going to come here. First, you have to pay attention carefully, slightly tricky it is, and slightly technical also. First, if there is a non-resident who is transferring some assets to a recognized stock exchange in IFSC. I am a non-resident, I am the transferor. I am transferring some assets to a recognized stock exchange in IFSC and the consideration is payable in foreign currency. Then the capital gain is exempt. Who is the transferor? Non-resident. Where he is transferring? In a recognized stock exchange in IFSC. Consideration is payable how? Consideration is payable in foreign currency. Then which assets is he transferring, sir? He is transferring bonds. He is transferring GDR as referred in 115 AC. Then he is transferring rupee denominated bond of Indian company, derivatives and such other securities as notified by central government. Has the government notified anything? Yes, the government has notified around 6 to 7 securities. Foreign currency denominated bond, units of mutual fund, units of business trust, units of AIF, foreign currency denominated equity shares, bullion depository receipts with underlying bullion, units of investment trust, being REITs, being InvITs, real estate investment trust, infrastructure investment trust, unit of a scheme, unit of exchange traded fund, ETF. All these things are also notified along with the first 3 points. If these items are transferred by NR through a recognized stock exchange in IFSC, not in Bombay Stock Exchange, not in National Stock Exchange, but in IFSC, then the capital gains will be exempt in the hands of non-resident. Now coming to next section, section 10(4)(d), this is also an exemption given to certain specified funds. Now we need to understand who are specified funds. There are 2 to 3 types of specified funds that we need to see. First, point number A, then point number B. These are the 2 types of specified funds. First, we need to understand them one by one. Sir, what is specified fund? It is a fund established in India. Established in India, how, sir? In the form of a trust or a company or a LLP or a body corporate. It is established in India in the form of a trust, company, LLP or body corporate. Plus, they have been granted a certificate of registration as category 3 alternative investment fund, or they have been granted a certificate as a retail scheme, or they have been granted a certificate as ETF as per the IFSC Act. So either they should be AIF as per point number 1A, or they should be ETF as per point number B, or they should be retail scheme. Plus, the fund should be located in IFSC. That is important. It cannot be, whether it is 1A, 1B, all of them should be located in IFSC. Plus, all the units are held by the non-residents. All the units of the funds are held by non-resident except the sponsor and the manager. Sponsor and manager can be resident. Who is sponsor? Who is manager, sir? Sponsor is one who has started the fund. Manager is someone who is managing the fund, who is the manager of the fund as of now. Now, condition number 3, there is some relaxation. Condition number 3 says what? All the unit holders should be non-resident. But if this condition shall not apply, if during the year of issue, if the unit holder is a non-resident, but in subsequent year, they became resident. Suppose in the year in which I am issuing the units, in that year, the unit holder is non-resident. But subsequent year, if they become resident, then this condition will not be considered to be violated if it is up to 5% of the aggregate value and number of units. So up to 5% unit holders can become resident in subsequent years. But 5% in value also, 5% in number also. So up to 5%. In the current year, everybody has to be non-resident except sponsor and manager. But in subsequent year, if up to 5% become resident, that's okay. If it is more than 5%, then this condition is violated. If this condition is violated, you cannot call yourself as a specified fund. In this case also, there is one catch. Suppose current year there are 100 unit holders and the value is also 100. So up to 5%, say 4% became resident. So that's okay. But the moment they became resident, suppose they became resident in 27-28. So after the end of 27-28, within 3 months from the end of the financial year, in the year in which became resident, you should throw them out of the fund. It means you should liquidate their fund and they should cease to be the unit holder. So 5% margin is there, but only for that particular year, and within 3 months from that year, you have to liquidate them. You have to make sure that they are ceasing to be part of the fund. I hope it is clear to all of you. So this is the first part of specified fund. What is second part of specified fund? I will explain you in a very simple manner. The second part of specified fund is the investment division of an offshore banking unit. Sir, what is an investment division of an offshore banking unit? I will just read it once and then I will explain. It's an investment division of an offshore banking unit which has been granted a certificate of registration as category 1 foreign portfolio investor. Sir, what is an investment division of an offshore banking unit? Suppose a non-resident bank is there, foreign bank is there, Citibank is there, Standard Chartered Bank is there, Barclays Bank is there, Bank of America is there, Bank of Germany is there. Suppose there is a foreign bank and they have opened one investment division in IFSC. So if a foreign bank, a non-resident, opens an investment division in IFSC to invest in India, that particular bank will be called as, that particular entity will be called as, that investment branch in India in IFSC will be called as what? The investment division of offshore banking unit. You can check it over here. Plus, they have to fulfill certain conditions, like they have to furnish an annual statement on or before the due date of filing of return of their exempt income. Plus, they have to maintain separate accounts. They have to do audit. They have to maintain proper documentations with respect to how much money has come to India, how much money has gone out of India. They have to maintain all the bank statement. They have to maintain all the contract notes. They have to maintain all the statement of security issued by the custodian. All these things they are supposed to maintain. Now, once you know what is a specified fund, now we will see which incomes of the specified funds are exempt in 1040. Let's check which incomes of specified fund are exempt over here. First, income from transfer, that is, which income comes from transfer, that is capital gains. Capital gains income, which capital gains? Which is mentioned in 47(7)(ab). It means all these capital gains which we have seen in the previous section. That is the reason we are doing this section first and then we are doing 1040. The order of the book is in the most precise manner and it is in the most accurate manner that one can have. So first you need to know what is 47(7)(ab), because without knowing 47(7)(ab), you cannot know 1040, because there is a reference of 47(7)(ab) in 1040. Therefore, all these assets which this non-resident was transferring, this also, here also, for specified fund also it is exempt. Second, income from transfer of security. Again, which income comes from transfer? Transfer income is always capital gains income. So income from transfer of any security except the resident company shares. Except resident company shares, all other securities, whatever they transfer, if there is a capital gains, that is completely exempt. Okay, long term, short term, everything is exempt. Third, income from securities. Now this is which income? This is dividend or interest income. This is not income from transfer. This is regular income. Income from securities issued by non-resident. But that non-resident should not be a PE of India. That non-resident should be outside India, and such income should not accrue or arise in India. That income should accrue or arise outside India. Okay, that should not accrue or arise in India. And fourth one, income from securitization trust. Do you remember that securitization trust? A bank is there, a debtor is there. Now the bank sells the debtor to a securitization trust, and securitization trust raise money from the investors and give them securities. So if you have invested in this securitization trust, which is chargeable under PGBP, that income will also be exempt. Now there is one more catch over here. The exemption over here is only restricted to the amount of units which are held by non-resident. If 70% units are held by non-resident, then only 70% amount of the income will be exempted, not the entire amount. For that, the government has given this equation: dividend and interest income into asset under management held by non-resident. How much asset under management is held by non-resident divided by how much asset under management is held by all the unit holders, that much amount will be subject to what? That much amount will be subject to exemption. Over and above that will be subject to tax. I hope it is clear to all of you. Now, let's move on to the next section. That is section 47, 6AC and 6AD. What is happening in 6AC and 6AD? Let me tell you. In 6AC and 6AD, what is happening? There is an original fund outside India and there is a resulting fund outside India. First of all, the law wants to close that original fund. The law wants that the original fund should close outside India and they should come to India and make a new fund that will be called as resulting fund. First of all, we will see the meaning of original fund. Original fund means a fund which is established outside India, which collect funds from the members and fulfills the following four conditions. First, it is not a person resident in India, it is a foreign resident. Second, India has a DTAA with that country or India has notified that country, okay, for the purpose of this section. Third, they should have an applicable investor protection regulation. It means in their country also there should be something like SEBI, etc. And fourth, they fulfill such other condition as may be prescribed. This is the first part of original fund. Second original fund is nothing but Abu Dhabi Investment Authority, which is owned by the government of Abu Dhabi. So if there is an Abu Dhabi Investment Authority which is owned by the government authority, the government is saying that close that, come to India. Okay. Now third one is some other notified funds which the central government may specify. Okay, the central government may specify some other notified fund. Further, the aggregate participation in the original fund by the resident in India shall not exceed 5%. It means the aggregate participation in the fund by the Indian resident should be up to 5%. It should not exceed 5%. Now we want them to close and come to India and make a resultant fund. Close original fund outside India, come to India, and in India when you will make the fund, that will be called as resultant fund. What that fund will be like? It will be incorporated in India. It will be in the form of a trust or company or LLP which is located in IFSC and has been granted a certificate of registration of category 1, 2, 3 AIF, or has been granted retail scheme, or has been granted exchange traded fund. Either of the three they should be. So the fund should be located in India. That too, it should be located in IFSC. It should be in the form of a company, trust, LLP. It should be in the form of category 3, category 1, category 2 AIF, or a retail scheme or exchange traded fund, and it should be as per SEBI and IFSC Act. Now all these conditions are fulfilled, then you will get two exemptions. First, whatever assets are transferred from the original fund to the resultant fund, all will be exempt under 47(7) AC, and the unit holders will also transfer their units. Whatever units are transferred by the original fund unit holders, and in exchange they are taking the units in the resultant fund, that exchange will also be exempt under section 47(7) AD. I hope it is clear to all of you, just like amalgamation. Next one, some small 47 exemptions are there. Then we will go to some conversion of entities cases. First, 47(7) AE. What is happening over here? Any transfer of capital asset by whom? By India Infrastructure Finance Company Limited. Who is the transferor? India Infrastructure Finance Company Limited. To whom? To an institution which is established for financing infrastructure and development. So the transferor is India Infrastructure Finance Company Limited, and they are transferring to an institution for financing infrastructure and development, then that is exempt. Next one, 47(7) AF. Any transfer of capital asset under a plan approved by central government. Central government is approving the plan of transfer of capital asset by a PSU to another PSU. So the transferor is PSU and the receiver is also PSU, and the receiver can also be central government or state government. So I am the transferor, I am a PSU, or I am a receiver, I am a PSU, or receiver can also be central government and state government, then that is also exempt. Okay. Next. Any transfer of interest in a joint venture by a public sector company. So there is a public sector company over here and there is a joint venture over here. Now this public sector company has the interest in joint venture and there is a foreign company over here. Now what is this public sector company doing? This public sector company is giving the interest and in exchange taking the shares of the foreign company. So giving the interest in joint venture and taking the shares of foreign company is exempt. Okay, so this is what it is written over here. Later on, now what will happen after this exchange? Now this public sector company has shares of foreign company. Later on, when they will sell the shares of foreign company, what will be the cost of the share? The cost of the share will be same as the cost of interest. Check here 49(2) AI. The cost of share received on conversion will be same as the cost of interest in the joint venture. I hope it is clear to all of you. Now let's move to the next part, which is a very important part for examination. 47(13). What is 47(13), sir? Conversion of a firm into a company. If a firm is getting succeeded into company in a business, then it is exempt. If it is succeeded in a profession, then it is not exempt. This exemption is only available for conversion of a firm into company into a business, not into a profession. I hope it is clear to all of you. Now, whatever assets will be transferred from firm to company will be fully exempt. If a firm is converted into company into a business, whatever assets are transferred from firm to company will be fully exempt subject to 4 conditions. Condition number 1, all the assets and liabilities of the firm should be transferred to the company. Condition number 2, all the partners of the firm shall become the shareholder in the company in the same proportion in which their capital account stood. All the partners should become the shareholder, not in PSR, but in the ratio in which their capital account stood in the firm. Third, the partner should not receive any other consideration except the shares in the company. The partner should only receive the shares in the company, not any other consideration. And the fourth and the most important condition, the aggregate shareholding of all the partners which are going from firm to company should be at least 50%, and they should maintain that for a period of 5 years from the date of conversion or date of succession. So they should maintain that for a period of how many years? Period of 5 years. Now 47(14) also similar. It is just one change is there, that now we are converting a sole proprietor into a company. If a sole proprietor is converted into company, then also capital gains is exempt when you transfer capital asset from sole proprietor to company, subject to only 3 conditions. Now condition number B not applicable. Apart from condition number B, all other conditions are applicable. I hope it is clear to all of you. Now there are some issues which are with respect to these 2 points. With respect to firm to company, there is one issue. The condition number 2 in case of firm, which is not applicable for sole proprietor, condition number 2 is only applicable to firm. But with respect to condition number 2, there is one issue. The issue is, pay attention absolutely. The issue is, what is condition number 2? That all the partners shall become the shareholder in the company in the ratio in which their capital account stood. Capital account ratio is important. Now, what if some of the partners' capital account is negative? Then how will we find our ratio? One partner's capital is 10 lakh positive, another is 10 lakh positive, third one is 5 lakh negative. How will we find the ratio? In that, finding out ratio is not possible. Then in that case, you tell that partner to bring capital in the firm and make it positive before succession. You can tell that partner to bring capital in the firm and make it positive, and then only succession is possible, otherwise not possible. PGBP is not exempt. PGBP will not be subject to exemption. PGBP will be taxable even in case of conversion. When a firm is converted into company or sole proprietor is converted into company, capital gain is exempt under section 47. In PGBP there is no exemption. I hope it is clear to all of you. Now later on, when the company will sell all the assets, you are a firm, I am a company, you are giving me all the assets, capital gains exempt for you. Now later on, when I will sell the assets in future which I have received from you on conversion, what will be the cost in my hand? The cost to the previous owner as per section 49(1). Cost to the previous owner. The period of holding will also be club, and also section 72A will be applicable over here. Whatever losses are there in the hands of the firm will, and in the hands of the sole proprietor, will continue to be carried forward by the company, will continue to be carried forward by the company for balance number of 8 years, for balance number of years, not for another 8 years. Okay, for balance number of years. I hope it is clear to all of you. Plus losses will only, I have already shown you this earlier while doing amalgamation. You can check it over here. I made this chart in which all section 72A is applicable, so I may not say this again and again. I hope it is clear to all of you. Now coming back to the discussion. Now coming to next section 4713B. What is happening here? There is an unlisted company, there is a private company, and now that is converted into LLP. So if there is an unlisted company and private company which is converted into LLP, then 2 exemptions are available subject to 7 conditions. Exemption number 1, whatever assets are transferred from the company to the LLP are exempt, and whatever shares are transferred by the shareholder, because now you are a shareholder, in future you will be becoming the partner of the LLP, so you have to transfer the shares. Whatever shares you are transferred, that will also be exempt subject to 7 conditions. Out of the 7 conditions, 4 conditions are same only which was there for firm to company. 3 conditions are new condition. First 4 conditions are same. First, all the assets and liabilities should be transferred to LLP. Second, all the shareholders of the company should become partner of the LLP, and their capital contribution and PSR should be same as the shareholding ratio. So whatever is the shareholding ratio, that same ratio will be applied for capital contribution and also for PSR. Third, the shareholder do not receive any consideration other than the share of profit. Same condition. Fourth, the aggregate participation, the aggregate PSR of all the shareholders should be at least 50%, and it should continue for a period of 5 years. Fifth, 6, 7, these 3 are new conditions. This was not there in case of firm to company. Now, the turnover of the company for any of the last 3 years should not exceed 60 lakh rupees. So the turnover should be maximum up to 60 lakh rupees in all the 3 years. It should not exceed 60 lakhs in any of the 3 years. Plus the book value of the total asset. The total book value of the assets in any of the time in the last 3 years does not exceed 5 crore rupees. So the book value of assets should not exceed 5 crore in any of the last 3 years. And last but not least, the company might have some P&L account balance that will obviously be transferred to all the partners in their shareholding ratio. So whatever is the profit available in the company's P&L account, which will be transferred to the partners, that partner cannot use for a period of 3 years. For a period of 3 years, they cannot withdraw the amount available in the P&L account, which is transferred to their respective partner capital account. They cannot withdraw that for a period of 3 years. If these 7 conditions are fulfilled, 2 exemption, whatever assets are transferred from company to LLP exempt, and whatever shares are transferred by the shareholder, that will also be exempt under section 4713B. Now, later on, all the assets have come to the LLP. Later on, LLP will sell the assets. What will be the cost of acquisition LLP? The cost to the previous owner. Cost of improvement will be the cost to the previous owner. Period of holding will be club. Now, one more thing. Here also 72A is applicable. Business loss, non-speculative business loss can be carried forward by LLP for balance number of 8 years. And UAD can be carried forward for infinite number of years. Now, one last thing I would like to say over here is, that is, the company might also have a MAT credit. So can the MAT credit will also be transferred to the LLP? Answer is no. The MAT credit will not be transferred to LLP. The MAT credit which is lying with the company will lapse the moment it is converted into an LLP. One last thing, if any of the conditions are violated, then whatever exemptions you have taken earlier, that will be subject to deemed income. So you should not violate any condition in future. Here also you should not violate any condition, and here also you should not violate any condition. If you violate any condition, whatever exemption you have claimed, that will be subject to deemed income in future, and whatever losses you have set off, that will also be subject to deemed income in future. I hope it is clear to all of you. Next one, 4713. Slightly technical in nature. What is this, sir? Conversion of a stock exchange into a company. Sir, what is this exactly? Generally, what happens? Initially, every stock exchange is made in the form of an AOP BOI. Suppose in 1972, there is one AOP BOI which was formed in the form of a stock exchange, and I was the member of that particular stock exchange. And how did you become the member of that stock exchange? I became the member of that stock exchange by buying the membership right of that stock exchange for 1 lakh rupees. So in 1972, I purchased 1 lakh rupees membership right from the stock exchange, which was AOP at that time. Now, after 35 years in 2015, now that stock exchange is getting converted into a company, that is becoming a corporate. This is called as demutualization or corporatization of a stock exchange. What it is called as? Demutualization or corporatization of a stock exchange. So if a demutualization or corporatization happens, how the capital gains implication will come? So now a AOP is converted into a company. If AOP is converted into a company, which is a stock exchange, all the assets and liabilities should be transferred from here to there, and such change should happen as per SEBI regulation. If all the assets and liabilities are transferred and such change is happening as per SEBI regulation, then the entire capital gains will be exempt. Whatever capital assets are transferred from AOP to the company will be fully exempt. Okay. Further. The shareholders should also do what? The shareholders should also have one thing. First of all, I will tell about the capital asset. Whatever capital assets are transferred from AOP to the company is exempt. Later on, when the company will sell the asset, the period of holding will be clubbed. The cost will be the cost to the previous owner. That is mentioned over here. This is the first tax implication. Second tax implication. Today, I am a member of an AOP BOI. How did I become the member of an AOP BOI? In 1972, I purchased the membership right for 1 lakh rupees. Now, the AOP BOI is getting closed. So what should you do for exemption? Give your membership right back, and in exchange, take equity shares in the company and also take trading and clearing rights for the purpose of trading in the stock market. So you have to take two things in exchange of one. Give the membership right and take trading and clearing rights and take equity shares. Later on, when I will sell that equity shares and trading and clearing rights, first of all, giving membership right and taking these two things is exempt under section 4713A. This exchange is not subject to tax. Now in future, I have two things. One is equity share and one is trading and clearing rights. What is the cost of acquisition of equity share, sir? The cost of acquisition of equity share will be the cost of the original membership, that is 1 lakh rupees, which you have paid in 1972. Here also you do not get the benefit to take FMB as on 1/4/2001. There are two places under income tax law where you cannot take FMB as on 1/4/2001. One is conversion of what? Conversion of this, and second is self-generated goodwill. Self-generated goodwill or any kind of intangible assets, you cannot take FMB as on 1/4/2001. And what will be the cost of the second item, that is trading and clearing rights? The cost of trading and clearing rights will be considered to be nil. That will be considered to be nil. So the cost of equity share will be the cost of membership right without FMB as on 1/4/2001, and the cost of trading and clearing rights will be considered to be zero. Both the definitions are given under section 55. Last but not least, here also the period of holding will be clubbed. The period will be counted from 1972 only to determine whether the asset is long term or short term. Last but not least, whatever depreciable assets are received in this entire process from AOP to the company, the WDV in the hands of AOP, that will become the cost in the hands of company as per explanation 12 to section 43(1). As per explanation 12 to 43(1), whatever is the WDV in the hands of the predecessor will become the cost in the hands of the successor. So this is what this provision is all about. Not much important. The previous two one were very important. That is the conversion of firm into company, as proprietor into company, or company into LLP. Those three are very important for examination. Now let's move on to the next part, which is a small part. That is what? That is section 51 section versus section 56(2)(9). What is this, sir? I am trying to sell my capital asset to someone, and I took what? I took some advance from you. And later on, the capital asset was not able to transfer because of some negotiation problem. We were not able to transfer the capital asset, and I forfeited your money. So what is the treatment of this forfeiture? So whatever amount you forfeit in negotiation of transfer of a capital asset, what is the treatment of that particular forfeiture amount? The treatment of that depends upon when it is forfeited. If it is forfeited before 1/4/2014, if it is forfeited before 1/4/2014, then the treatment is different. And when it is forfeited after 1/4/2014, then the treatment is different. Let's talk about before. If it is forfeited before 1/4/2014, then you should not do anything now. Whenever the asset will be sold, at that time you should reduce the amount forfeited from the cost of acquisition. But there is one catch over here. Only the amount which is forfeited by you will be reduced from the cost of acquisition. The amount which is forfeited by the previous owner will not be reduced from the cost of acquisition. For example, in 2005, I purchased the asset. In 2006, I am trying to sell the asset to someone, but the other person did not pay me the full money. So I forfeited 1 lakh rupees. Now, in 2009, I gifted this asset to my wife. Now, my wife is also trying to transfer it to someone. She also forfeited in 2009 1 lakh rupees. Now, my wife is selling in 2012. So, my wife will reduce from cost of acquisition only the amount which is forfeited by her and not by me. Amount forfeited by the previous owner should not be deducted while computing the cost under section 51. But if the amount is forfeited on or after 1st April 2014, then you don't have to check all these things. Then in that case, it is very simple. If an amount is forfeited on or after 1st April 2014, then whatever amount is forfeited, that will be directly considered as income from other source under section 56(2)(9). As simple as that. You don't have to do all these things. So the date of forfeiture is absolutely important. According to that, the treatment will change. Okay. Now, next part 8. Exempt capital gains and special tax rate. There are 3 exemptions under capital gains. We will talk about them first one by one, and then we will talk about 112A capital gains tax rate and 111A capital gain tax rate. Section 1033. What is 1033, sir? If you transfer unit of a unit scheme, it is exempt. It's a very old unit of a unit scheme, came in somewhere around in 1962-63. If you transfer that unit, it's a government scheme. If you transfer that unit of a unit scheme, it is exempt under income tax law. Nothing great as such. Let's move on to the next one. Section 1037. Section 1037 gives you exemption with respect to transfer of urban agricultural land. This exemption is available to whom? You should be individual and HUF. First of all, you should transfer urban agricultural land. That too which is used by you or your parents, or it is used by HUF. It is used by SSC himself, individual, or his parents, or by HUF at least 2 years prior to the date of transfer for agriculture purpose. So this condition number C is very important. First condition, you should be individual HUF. Second condition, the land should be agricultural land, but urban agricultural land, because rural agricultural land is anyways not subject to tax. Third, the most important condition, the agricultural land should be used for agriculture purpose, either by the SSC or his parents or HUF for at least 2 years prior to the date of transfer. Then such land is compulsorily acquired by the law. Who is acquiring that law? Such land is compulsorily acquired by the law. Then whatever the original compensation as well as the enhanced compensation, both are exempt. There was a debate whether enhanced compensation will be subject to exemption or not. Supreme Court has clarified in the case of Balakrishnan versus Union of India and others in 2017 that yes, even the enhanced compensation will be subject to exemption. Don't worry. So if this land is compulsorily acquired, then it is exempt under 1037. What if I sell this land voluntarily? If you sell this land voluntarily, then it is not exempt. Then it will be subject to what? Then it will be subject to exemption provided you reinvest in another land within 2 years as per section 54B, which we will see after some time. So if it is compulsorily acquired, then directly exempt. But if it is sold, deliberately sold by the SSC, then you have to put some effort and reinvest it. You reinvest it and it will become exempt. I hope it is clear to all of you. Now next one, 1037A. Formation of new capital city of Andhra Pradesh, that is Amaravati. You all know that on 2nd of June 2014, especially South Indian students, because the lectures are in English, most of the South Indian students are watching this. Therefore, you are aware of that. The Amaravati, that is the Andhra Pradesh and Telangana, was split up in two parts on 2nd June 2014. At that time, the Andhra Pradesh said that we want to make our own capital because Hyderabad was taken over by whom? It was taken over by Telangana. So Andhra Pradesh said that we will make our own capital. So what is the status of that own capital? They said that we'll make one own city by the name called as Amaravati. The state got split up on 2nd of June 2014. So what they are doing? They are pooling land from people. And in exchange, they are giving land pooling ownership certificate, LPOC. So what is the treatment of all these things? Let's see one by one. You will get a lot of capital gain exemption over here. First, the assessee should be individual and HUF. Second, the assessee should be owner of a land and building on 2nd June 2014 when the split was done between the two states. Third, such land is transferred under land pooling scheme. If these three conditions are fulfilled, there will be a lot of exemption. Exemption number 1. I have a land in Andhra Pradesh. So I gave my land in exchange. I took LPOC, land pooling ownership certificate, exempt in point number 1. Now what do I have? I have LPOC. Now, if I want to sell this LPOC, that LPOC, if I transfer and if I earn some money, that is also exempt in point number 2. Now, suppose if I am not selling the LPOC, but I am keeping the LPOC, what is the use of that LPOC? In future, in the new city Amaravati, you will get a reconstituted plot of land. So say after 10 years or 5 years or 15 years, whenever it is, still the Amaravati is not completed, still it is going on because of political disputes. The story I have told you in the class, okay? So, suppose today, after 10 years, I got the land. Which land? Reconstituted plot of land. Say I got the land in 22-23. After I get the land in 22-23, now if I sell this new land also within 2 years from the end of 22-23, that is also exempt in point number 3. Check please. So whenever you will get this new land, if you sell that land within 2 years from the end of that financial year in which the land was given to you, the possession was given to you, that will also be exempt. What if I sell after 2 years? If I sell after 2 years, then it will be taxable. Now, if it is taxable, what is the sale consideration? The sale consideration will be the actual selling price. What will be the cost of acquisition? The cost of acquisition will be the stamp duty value when on the last day of the financial year when 2 years expire. Suppose the land was given in 22-23. When 2 years expire, 2 years expire on 31st March 2025. If I sell till 31st March 2025, then it is obviously exempt. If I sell after 31st March 2025, you have to take stamp duty value on 31st March 2025 as your cost of acquisition as per section 49. I hope it is clear to all of you. Now let's move ahead towards the next section, which is one of the most critical section for your CA final examination, 112A. 112A we are going to do first, and then we will do 111A. 112A, tax on long-term capital gains on certain assets. There are 4 assets which are covered over here. Long-term equity share, long-term equity oriented fund, long-term ULIP, which is not exempt under 1010D. Which is not exempt under 1010D due to percentage criteria. If it is not exempt or due to amount criteria, it is not exempt. It doesn't matter. Both the cases now comes under 112A only. Even if it is taxable due to percentage criteria or even if it is taxable due to amount criteria, it will come in 112A only. And units of business trust. So 4 items are there. Now, for equity shares, you have to fulfill 2 conditions. For equity shares, you have to pay STT both at the time of purchase and sale. For equity shares, you have to pay STT both at the time of purchase as well as at the time of sale. But in equity share, at the time of purchase, in 2 cases, you may not pay the STT. It's okay. If the purchase was done before 1st October 2004, then on purchase of equity shares, STT payment is not required because STT concept came from 1st October 2004 only. Before that, STT concept was not there only. So, by default, on equity share, you should pay STT on purchase and sale both. But there are 2 exceptions. First, if it is purchased before 1/10/2004, 1st October 2004, and then STT is not paid, then it is okay. Second, there are few notified cases which are mentioned below. I am highlighting, like if you purchase in IPO, STT not paid, it's okay. Bonus shares, STT not paid, it's okay. Subscription by non-resident through an FDI policy, STT not paid, it's okay. Then section 47 cases where you get the shares in amalgamation, demerger, slump sale, lot of cases you get the shares. Okay, in that case also, if you have not paid STT on purchase, it's okay. So again, I am saying this is the most important part. By default, STT has to be paid for equity share both on purchase and sale. But two cases on purchase, if you don't pay STT, it's okay. Once if it is purchased before 1st October 2004, and once where it is purchased in some notified cases. Now, in case of other three assets, that is equity oriented fund or ULIP which is not exempt or unit of business trust, only STT is supposed to be paid on transfer. STT on purchase is not required. If it is paid, great. Even if it is not paid, it's okay. I hope it is clear to all of you. Plus one more relaxation. If your stock exchange is located in a IFSC, then STT is not applicable only. In IFSC, whenever you purchase or sell any shares, STT is not applicable on purchase also, STT is not applicable on sale also. In that case, you are not supposed to pay what? You are not supposed to pay STT. Still, you can get the exemption of 112A. So, this is the only case where without paying any STT on purchase as well as sale, you can claim benefit of section 112A. I hope it is clear to all of you. Next, now the most important question, how much is the capital gains? The capital gains is 12.5% tax plus surcharge if applicable and 4% cess, and 1,25,000 exemption per year you will get, irrespective of the nature of entity. Individual, HUF, firm, AOP, BY, company, LLP, resident, non-resident, everybody will get an exemption of 1.25 lakhs. 1.25 lakh is a standard exemption for everyone. Apart from that, for resident, individual and HUF, you will also get the benefit of exhausting the basic exemption limit from this capital gains. But this benefit, exhausting the basic exemption limit benefit is only available to resident, individual, HUF. Suppose your long-term capital gain is 6 lakh rupees. Okay. So first you reduce 1.25 lakhs. Now what is left? After that 4.75 lakh is left. Now you reduce 4 lakh rupees basic exemption limit from in new regime. The basic exemption is 4 lakh. Now you reduce 4 lakh rupees. After that, whatever amount is left, on that you have to pay 12.5%. But remember, the basic exemption limit should be first exhausted against other income like salary, HP, PGBP, and if balance is left, then you can set off against what? Against the special income like 112A. This basic exemption limit is only allowed to set off for residents, individual and HUF. It is not allowed to set off for non-resident. Even 111A you can set off basic exemption limit. Even in 112 you can set off the basic exemption limit. Now coming to the grandfathering clause. Sir, what is grandfathering clause? Grandfathering clause is applicable where you have purchased the shares before 1st February 2018. If you have purchased the shares before 1st February 2018 and if you are selling the shares after 1st April 2018, then grandfathering clause is applicable. Always remember, whenever in the exam 31st January 2018 date will come, your mind should click that it is a case on grandfathering. Whenever 31st Jan 2018 will come, it means it is grandfathering clause. Always remember this. Okay. Now, how to compute cost in case of grandfathering clause? Then there are two steps over here. Step number 1, you should find out your actual cost of the share or units. Whatever actual cost of the shares and units is there, you should, point number 1 will be there. Point number 2 is lower of two items. That is FMV on 31st January 2018 and full value of consideration, that is the price at which you are selling the shares today. Then whichever is lower you will take, that as point number 2. Then point number 2 and 1, whichever is higher, that will become your cost of acquisition. So point number 1, actual cost. Point number 2, lower of two items compared with point number 1, whichever is higher, that will become your actual cost for the purpose of computation of capital gains. Now sir, how to compute the FMV on 31st Jan 2018? How to compute FMV on 31st Jan 2018? For that also the law has given very clearly. Suppose your shares are listed or units are listed on 31st January 2018. If your shares or units are listed on 31st Jan 2018, then take the highest price of that date. On that day, whatever is the highest price, take that date. Take that day's highest price. Suppose on that day the shares were not traded on the stock exchange, then you take the highest price on the immediately preceding date when it is traded. Say 30th Jan, 29th Jan, 26th Jan, 27th Jan, whenever it is. Okay. Whenever it is traded, you have to take the highest price on that particular date. By default, you should take 31st Jan. If that is not possible, then go to the preceding date. Suppose now your units are not listed on 31st Jan. If your units are unlisted on 31st Jan, then take NAV on 31st Jan as the FMV. Whatever is the net asset value of that particular unit, that will become the what? That will become the FMV on 31st Jan for the purpose of grandfathering clause. Okay. Third one, shares are not listed on 31st Jan. Then what to do? Later on, when you transfer the share, at that time it was listed. Then you have to bring the value of that share to 2017-18. Suppose you purchased the share in 2010 for how much? For 100 rupees. Now you have to inflate that value till 2017-18. That is till 31st Jan 2018 by doing indexation. So whatever is the cost multiplied by, take indexation of 272 divided by indexation of the year in which you purchased the share. And if you purchased before 2001, then you have to take the value as 100. Okay. So in this case, when the shares are not listed on 31st Jan, you don't have to compute fair market value and go by going to the market. Just index till 2017-18. That itself will become the cost of acquisition, and that itself will become the FMV on 31st Jan 2018. And then you apply that that in the cost of acquisition table. Okay. Now there are some more issues over here. Point number one. First pro issue to 48 is not applicable to 112A share. I have told you while teaching you the first pro issue to 48, where the non-resident and foreign company purchase the shares or debentures or bonds of Indian company in foreign currency, you have to do TTBR, TTSR, TTBR, TTSR. But that to TTBR, TTSR you should not do for equity shares, etc. covered under 112A. First pro issue to 48 is not applicable to 112A shares. Second, against long-term capital gains, you cannot claim ATC to ATU. You cannot claim ATC to ATU against any special long-term capital gains. You cannot claim against 112A also. You cannot claim against 112 also. You cannot claim against 111A also. Okay. Third, rebate under 87A is not available against 112A. It is not available in the new regime also. It is not available in the old regime also. Okay. So rebate under 87A is not available against new regime also. It is not available against old regime also. Next. Losses under 112A. If there is a loss, then loss you can definitely carry forward and set off. The way gain is taxable, the loss is also subject to what? Exemption over here. One last thing over here, then we will move ahead to towards the exemption under section 54. 111A. 111A is exactly similar to 112A with some changes. I'll tell you the changes directly. 112A is for long-term capital gains. 111A is for short-term capital gains. 112A is 12.5%. 111A is 20%. In 112A, you get 1.25 lakh exemption. In 111A, you don't get any 1.25 lakh exemption. Plus, in 112A for equity share, you have to pay STT on purchase also. But in 111A, you don't have to pay STT on purchase to take this benefit. Apart from that, everything is same. Nature of asset is same. Everything is same. That is long term. This is short term. That it is 12.5%. Here it is 20%. That is there you get 1.25 lakh exemption. Here you don't get 1.25 lakh exemption. There it is necessary to pay equity shares STT on purchase also. Here it is not necessary to pay. I hope it is clear to all of you. One last thing over here. Whenever you sell any shares and security, whether that will be taxable under capital gains or PGBP, that all depends upon case to case. CBDT has issued a circular whereby they have said that we cannot give you one thumb rule, but they have said few things which I will tell you. That is, if the assets are held for, if the shares are held for more than 12 months, then generally it should be held as capital assets. Further, if the assets are shown in the balance sheet as stock in trade, then it will definitely be called as what? PGBP. But if it is held for less than 12 months, then it has to be decided based on case to case, whether it is a capital gains or whether it is a PGBP. I hope it is clear to all of you. So I will take a break of 2-3 minutes now, and then we will continue with the next part. Okay. Till then, you all can comment. How is it going? Oh. Both are same only, Sanket. It doesn't matter. This will also be re-uploaded in one single file later on. Right now I'm taking live, then I will re-upload by making a single file. That it is easy for you to identify and search during exam. So let's go ahead with the next part, that is exemption under section 54 to 54 GA. We will talk about the first exemption first of all, and then rest of the exemptions are nothing but comparative to each other. Section 54, we will talk about what are you transferring over here. I am transferring a long-term residential house property, house, not any other property, residential house property. What am I supposed to purchase? You are supposed to purchase another residential house property plus in India and up to 10 crore. If you purchase for more than 10 crore, then your exemption will be restricted to 10 crore only. You will not get more than exemption of 10 crore rupees. I hope it is clear to all of you. Now, when should I purchase? You should purchase a house 1 year prior to 1 year before the date of transfer, or you can also purchase within 2 years from the date of transfer, or you have to complete construction within 3 years from the date of transfer. So three options are there. Today I am transferring the house. I can purchase in the last 1 year, I can purchase in the next 2 years, or I can complete the construction in the next 3 years. Now, suppose I am selling the house in December 2025. Now, I have a time limit to purchase the house till 2 years, and I have a time limit to construct the house till 3 years. But in between, there will be due date of filing of return in which I have to disclose my capital gains. So the best thing is you should purchase the new house before the due date of filing of return. But if that is not possible, you have an option to deposit the money in scheme of deposit, which is mentioned in note number 1. So whatever capital gains you want to exempt, that much amount you can deposit in the scheme of deposit till the due date of filing of return. You cannot deposit after the due date. If you deposit after the due date, then the exemption will not be available. So whatever capital gain you wish to exempt, you have to deposit in the due date. You have to deposit in the capital gain account scheme, which is opened in certain banks, which is opened in nationalized bank, and now even private banks are open for that. Even in ICICI, HDFC, Kotak Bank, it is possible. So whatever capital gains you desire to get exempt, suppose your capital gains is 50 lakh rupees, you want to exempt full 50 lakhs, then invest full 50 lakhs in capital gain account scheme before the due date of filing of return. You cannot be late. If you come even one day late, then exemption is gone. So invest the money, you will get the exemption. Then what? Then withdraw the money in future and purchase the asset or construct the asset within the time. And if you don't do that within 3 years, then it will become deemed income of the third year. So whatever is the unutilized portion, that will become deemed income of the third year. Suppose you have invested 50 lakhs and you have withdrawn 30 lakhs and you have used that, and 20 lakh is unutilized. So 20 lakh will become deemed income. Unutilized portion will be deemed income. But in case of 54B, the time limit is only 2 years. It is not 3 years. In rest all section, the time limit to invest is 3 years. But in 54B, it is 2 years. Sir, what if I have invested in the capital gain account scheme and if I die, the SSC expired, then the legal heir of the SSC withdraws the money in the hands of the legal heir. It is always exempt. They are not obligated to reinvest. They can enjoy it without reinvesting. It is exempt in the hands of the legal heir. I hope it is clear to all of you. Now, next question, sir. How much amount will be exempt? Suppose my gain is 50 lakh. How much I am supposed to invest, sir? See, there are two types of exemptions under different sections. In some sections, you have to invest the gain. In some section, you have to invest the entire consideration. Now, in almost all these sections, except 54F, you have to invest gain only. The amount of gain or cost of new asset, whichever is lower, will be exempted. Suppose your gain is 50 lakh. So if you want to exempt 50 lakh, just invest 50 lakh. You don't have to invest the entire consideration. So amount of gain or cost of new asset, whichever is lower, will be exempt. But in 54F, one section is there where you have to invest the entire consideration. If you don't invest the entire consideration, then proportionate exemption will be available. Here in 54F, you have to invest the entire consideration. So if you fully utilize your net consideration, then capital gains is fully exempt. If the net consideration is partly utilized, not fully, then capital gains will be exempt as proportionate to this. That is, whatever is your capital gains multiplied by whatever is the cost of new asset divided by your net consideration. This much will be exempt, balance we will make it taxable. Okay, I hope it is clear to all of you. Now, last but not least, in every asset, when you purchase, when you repurchase, when you reinvest, you have to keep it for some years as a lock-in period. So what is the lock-in period? Now, generally, you should not transfer the assets, new asset within 3 years. But in case of 54EC, the lock-in is increased to 5 years. Sir, what if I sell the assets within 3 years? Then whatever capital gains was exempt earlier now, that will become deemed income. Sir, how it will be deemed income? For that, there are two approaches. One is called as reduced cost approach. One is called as full cost approach. I will explain you both of them with the help of example, with the help of this table. Okay. So by default, the new asset which you purchase, you should hold for how many years? 3 years. In 54EC, 5 years. But if you sell within 3 years or within 5 years, then you have to tax the capital gains which was exempt earlier. Whatever capital gains was exempt earlier, that will be subject to deemed income. Along with the new asset which you are transferring, that capital gains will also be subject to tax. Now, under section 54, under section 54B, 54D, 54G, 54GA, the treatment is different, and under 54EC and 54F, the treatment is different. Let's talk about the first box. How will you compute tax? How will you compute deemed income in these 5 sections? 54, 54B, 54D, 54G, and 54DA. Pay attention. Whatever is the full value of consideration of the new asset, take that. Then reduce transfer expenses. Then the most important point. Now don't take the cost of acquisition of new asset. Just adjust the cost of acquisition of new asset with the capital gains that you are going to withdraw. So whatever is the cost of acquisition of the new asset minus whatever exemption claimed earlier which you want to withdraw now, because you are selling within 3 years, you are breaking the promise. So whatever exemption was claimed earlier, that much you reduce from here, and then you show the reduced cost of acquisition and then cost of improvement of the new house if it is there, and then capital gains will come. Okay. Now, in these two sections, 54EC and 54F, what to do? Don't reduce from here. In 54EC and 54F, you have to show this capital gains exempted earlier separately, add over here. Okay, just check this particular table. FVC of new asset minus transfer expense. Now here you don't take reduced cost, you take full cost. Only the cost of the new asset. And the capital gains which you are supposed to withdraw, add separately over here. Sir, what to do in exam? How to remember that? See, it is very simple. Sir, when to follow reduced cost, when to follow full cost? It is very simple. If you are the asset which you are transferring and the asset which you are repurchasing, if the nature of that asset is same, house, land, if it is same, then you should go for what? You should go for reduced cost approach. If the nature of the asset is different, then you should go for full cost approach. You don't have to by heart all these things. I'll show you. This and this is same. therefore reduced cost approach. This and this is same, therefore reduced cost approach. This and this is same, therefore reduced cost approach. This and this is different, therefore full cost approach. This and this is different, therefore full cost approach. This and this is same, therefore reduced cost approach. You can check it this with the entire booklet, that wherever the nature of assets are same, transferring asset and the purchasing asset is same, then you are following reduced cost. If the nature is different, then you are following the full cost. Now, one last thing over here is the first section 54F is only 54, sorry, is only available to individual and HUF. It is not available to other than individual and HUF. Once I am done with this, I will go to the second section now. In the second section, what are you transferring? You are transferring an urban agricultural land which is used for agriculture purpose at least 2 years. By whom? By assessee himself or by his parents. Either the assessee is using or his parents are using. Now, once you transfer this land, then you have to reinvest in this land within 2 years, purchase another land. Another land can be rural agriculture, both the lands are okay. Even if it is rural, then also it is okay. Even if it is urban, then also it is okay. So if you sell this land, then 54B is there to save you, and if it is compulsorily acquired, then 1037 is there to save you. Okay, I hope it is clear to all of you. So what are you selling? Urban agriculture land. What kind of urban agriculture land? Which you were using for agriculture purpose, or your parents were using for agriculture purpose for at least 2 years. What are you buying? Rural or urban, both the lands are okay. Now, purchase within 2 years. Rest all is same. 54B exemption scheme of deposit is available. Amount of exemption, you have to invest gain, not consideration. Consideration is only invested in 54F. Lock-in period, same 3 years. Eligible assessee, individual HUF, same. So now the things will be repeated to a great extent. Third section, 54D. You have an industrial land and building which was used by you for industrial purpose at least for 2 years. So you have an industrial land, industrial building which you are using for your business purpose for at least 2 years. Now the government is compulsorily acquiring. You are not selling it. It is compulsorily acquired. So now you have to purchase another land, or you have to construct another building or purchase another building within 3 years. So if your industrial land and building which was used by you for at least 2 years, it is compulsorily acquired, and you purchase the land or purchase the house or purchase the building or construct the building within 3 years, your capital gains will be exempt. Always remember, because it is an industrial land and building, the building capital gains will always be short term because it is a part of block. But the land capital can be long term or short term as the case may be. Rest all provisions are same. If you don't want to buy till 31st July or 31st October, if you don't want to buy, if you don't want to reinvest till the due date of filing of return, you can put the money in capital gain account scheme, withdraw the money later on, and then purchase or construct within 3 years. Then amount of exemption, you have to invest the gain, not the consideration. Lock-in period, same 3 years. Now this is available to all assessees and not only to individuals and HUFs. It is available to everybody. Okay, because industrial land and building can belong to everybody. Now it has nothing to do with individuals and HUF. Now 54EC, one of the most important section of our chapter. Any long-term capital asset, only long-term capital asset. Which long-term capital asset? Only land and building. Shares are not covered here. Jewelry is not covered here. Painting is not covered here. Other assets are not covered here. Only long-term capital asset being land and building. Which land and building? It can be any land and building. It can be agricultural land, it can be commercial land, it can be residential house, it can be commercial office, etc. It has to be land and building which is long term. You sell that, and within 6 months from the date of transfer. Now here you don't have the time to invest in what? Capital gain account scheme and then withdraw and then again reinvest. All those things are not available here. You have to do what? You have to invest within 6 months in 6 type of bonds. First is NHAI, National Highway Authority of India bond, Rural Electrification Corporation Limited bond, Power Finance Corporation Limited bond, Indian Railway Finance Corporation Limited bond, Housing and Urban Development Corporation Limited bond, and Indian Renewable Energy Development Agency bond. The last 2 bonds are recently inserted in last 1 year. That is the reason we have highlighted in green color. So you have to invest in these bonds within how many months? Within 6 months. You don't have an option to invest in what? In 54EC. Sir, what is the amount of exemption? The amount of exemption is given in note number 4. The maximum amount of exemption in this section for a particular financial year is up to 50 lakh rupees. 50 lakh rupees per bond? No. All 6 bonds taking together should not exceed 50 lakh rupees. You can invest more than 650 lakh, but the exemption will be restricted to only 50 lakh rupees. You will not get an exemption of more than 50 lakh rupees over here. I hope it is clear to all of you. Then lock-in period. Here the lock-in period is also different, which is given in point number 9. The lock-in period over here is 5 years. For 5 years, you should not transfer these bonds. Plus, for 5 years, you should not take a loan against this bond. You cannot keep these bonds as a security and take a loan also. That is also not allowed for a period of 5 years. So 5 years you cannot take loan. For 5 years you cannot what? You cannot take security. You cannot transfer these bonds. Okay. If you do that, then deemed income will apply as per a reduced cost approach, not full as per full cost approach, not reduced cost approach, because the buying asset and the selling assets are different over here. Now, one more point I would like to address with respect to this issue in note number 10. Let me tell you this very clearly. This is also a very important issue, so that we will address this here only. Pay attention, please, all of you. Suppose in 2015, in 2010, I purchased an asset. I purchased the land. In 2020, I converted that land into stock in trade. Now, am I liable to tax in 2020? The answer is no. Yes, 2020 will be considered as year of conversion, year of transfer. FMB on the date of conversion would be relevant, but the tax will be charged in the year in which I sell the SIT. So, in 2010, I purchased the land as a capital asset. In 2020, I converted that into SIT. Now it will not be taxable. In 2025, I sold that land as a SIT. Now in this year, in 2025, I will be liable for capital gains as well as PGBP. Now I am computing capital gains, I am computing PGBP. Now I want to reinvest in 54 EC bonds. But the problem is 54 EC bonds says that you have to reinvest within 6 months from the date of transfer. Now the date of transfer gone in 2020, and now the chargeability is happening in 2025. So here the CBDT has given a relaxation in circular number 791, where they have said that for this case, the period of 6 months will be counted from the date of sale of SIT and not from the date of conversion. So the period of reinvestment will be counted. This is very important point. On this, there are questions also. The period of 6 months will be counted from the date of sale of SIT. Date of sale. SIT is sold when? In 2025. From here, 6 months period will be counted. Hello, 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 hello. Am I audible? Am I audible, guys? There was some connection issue. I hope I am audible. So suppose I have a building, I am a businessman, I have a building which is 10-year-old back building. Now that building is a part of block of asset. Now if I sell that building and if there is a short-term capital gains, can I reinvest in 54 EC and claim exemption? The answer is yes. Now you will say, sir, 54 EC is only applicable to long-term capital asset. Yes, correct. 54 EC is only applicable to long-term capital asset. See, the block of asset does not talk about the nature of asset. It only talks about the nature of gain. The block says that the block's gain is always short-term. The block does not say that the block's asset is always short-term. Therefore, you need to be very careful with this particular issue, that if the asset is a part of block, which is a long-term asset, but the gain is short-term, the asset is long-term, but the gain is short-term, you will be eligible to claim exemption under 54 EC. For 54 EC, you have to check the nature of asset and not the nature of gain. I hope it is clear to all of you. Now, coming back to the discussion, 54 EC. 54 EC is also available to all assessees. Every assessee can claim 54 EC, not only individual and HUF. Now, coming to 54F, which is also a very important section for all of you. What is 54F? You can transfer any long-term capital asset except residential house, residential house, residential house. Apart from residential house, sell everything which is long-term. Sell land, sell commercial office, sell jewelry, sell mutual fund, sell shares, and other than house, other than residential house, sell everything and buy a residential house in India up to 10 crore. So you have to buy a residential house plus in India and up to 10 crore rupees. If you invest more than 10 crore, your exemption will be restricted to 10 crore rupees. Now, when you have to purchase, same like 54, 1 year before the date of transfer or within 2 years from the date of purchase, or within 3 years from the date of construction. Whatever you are comfortable, you can do it, either of the things. Okay. Now, in 54F, 54F scheme of deposit is applicable. Obviously, if you don't want to purchase till the due date of filing of return, you can purchase later on. Then first you have to invest in the scheme of deposit, then withdraw the money and purchase later on. Now, what is the amount of exemption? The amount of exemption here, it is different. Here, if you want to exempt, then the entire net consideration has to be invested. Otherwise, only proportionate capital gains will be exempt, full exemption will not be available. Lock-in period is same. Lock-in period is 3 years only, and this section is also available to only individual and HUF. Now, I would like to say one thing with respect to this. One thing with respect to this is this section is available only on the date of transfer you do not own more than one residential house. If you already have more than one residential house, then this section is not available. You should either have no house on the date of transfer, or you should only have one house on the date of transfer. Only then this section is applicable. Otherwise, this section is not applicable for you. I hope it is clear to all of you. Next one, 54G. What is happening in 54G? You are shifting your business from urban area to rural area, and in that process, you are transferring your land, building, plant, machinery, except furniture. Then 1 year before or within 3 years, purchase or construct another land, another building, another plant, another machinery except furniture. So from where you are shifting from urban to a rural, and you are transferring your land, building, plant, machinery, and you are purchasing another land, building, plant and machinery within the period mentioned, that is 1 year before and within 3 years after. Okay, if you do that, your capital gains will be exempt. Rest all is same only like the previous section. 54GA is also exactly similar like 54G. There is only one difference. Here it is, you are shifting from urban area to SEZ. There you are shifting from urban area to rural area. Here you are shifting from urban area to SEZ. Rest all is same only. Okay, I hope it is clear to all of you. Now some important issues with respect to many sections. First, I would like to say some important issues with respect to 54 and 54F. What are you doing in 54? In 54, you are selling a residential house and buying another residential house. And what are you doing in 54F? You are selling all long-term capital asset other than residential house and buying a residential house. But in both the section, the law says that you should not buy more than one house. If you buy more than one house, then in that case, you will be getting the exemption with respect to only one house which has higher cost. In 54 also, if you purchase more than one house, you can claim exemption of only one house. And 54F also, if you purchase more than one house, you can claim exemption of one house. Obviously, whichever house has higher cost, you can claim that exemption. First thing is that. Now, but in 54 and 54F, in both sections, there is a Supreme Court judgment and also High Court judgment which says that if you have bought two houses which are adjacent to each other and you break the wall of that house, intended to make that as a one house, there are two houses, two agreement, everything is two, payment is also 2 time made, agreement also 2, but both of the houses are adjacent to each other. You are breaking the wall and making it one house, then it will be considered as one single house. Both the house will be considered as one single house if they are adjacent to each other. Okay, now this is also applicable for both 54 and 54F. Now the next issue which I am saying is only applicable to 54, only 54. The next issue is not applicable to 54F. If your long-term capital gain is up to 2 crore rupees, then the government is giving you once in a lifetime option that you can buy two houses also, that is two houses also, that is two houses also. So this benefit is only available under 54, that if your long-term capital gains is up to 2 crore, once in a lifetime option. Once you avail that option, then you will not get this option throughout in your life. So once in a lifetime option is you should avail, if you get what? Your long-term capital gain is up to 2 crore rupees, then you can take the advantage of what? Two residential houses also. Okay, in this case. But this benefit is not available for what? Is not available for what? 54F. Now, next some issues are there. Suppose I have a house. I have demolished that house. Now I have another house. I sold that house. The consideration of that house I am using to reconstruct my old house. Will I be eligible to claim exemption under 54? The answer is yes. So if you demolish your old house, reconstruct that by selling your another house, then the consideration used from there to there, that will also be subject to exemption. Next one, in 54 and 54F, it is written that the construction should complete within 3 years. Okay, the question is when the construction should start. There is no time limit when the construction should start. Construction may start even before the date of transfer. The construction may have started anytime. That is not relevant for the purpose of 54 and 54F. Next, if I paid the full consideration and I have obtained the possession of the house, am I eligible for exemption if I have not received the sale deed? The property is not registered. I have paid the money. I have took the possession. I'm using the house for my personal purpose, but I have not got the registration. So registration is not relevant for the purpose of claiming exemption. Investment and taking the possession is important for claiming exemption. Next, I sold my house and the next house which I repurchase in the name of my wife. The consideration is paid by me. Everything is paid by me. It is just that I registered in the name of my wife. So can I purchase the new house in the name of my wife? The Delhi High Court has said in the case of Kamal Wahal that yes, your wife is not a stranger. You are not purchasing any asset in the name of a stranger. Therefore, you can definitely purchase the house in the name of your wife. So far as the consideration is paid by you, it doesn't matter if even if you purchase in the name of your wife or father or mother or children, etc. Okay, I hope it is clear to all of you. Now, next issue is given in point number 11. Now there are some case laws which are over here one by one. I will tell you all of them. Okay. Now in point number 11, the SSE is claiming exemption under 54G, where they are shifting their business from urban area to rural area. Now they have given the they have to repurchase some new plant and machinery, plant furniture, plant machinery, land building. So for that they have given advance. So whatever the advance they have given for land building, plant and machinery, can that be claimed as an exemption, or advance cannot be claimed as exemption? You have to actually purchase the asset. No, giving advance is also subject to exemption. Consideration should be reinvested. That is important criteria. If you reinvest even by giving an advance, you will be eligible for claiming exemption. Next one, CIT versus Gurnam Singh. What is happening in this case? Gurnam Singh is claiming exemption under 54B, and while reinvesting in the land, he purchased the land and in the co-ownership of his son. It means in the land, the co-owner was son also. The son was also a co-owner to some extent. Can he claim exemption? The answer is yes. Even if the son is co-owner, it doesn't matter. You will be eligible to claim exemption. Okay. Next one, 54F. In 54F, you have to purchase new residential house. You have to purchase another residential house. So I purchased another residential house. I constructed that residential house, but some finishing work was pending. Like some tiling work was pending, flooring work was pending, then some electrical fitting work was pending, etc. Can I claim exemption? The answer is yes. These are just preliminary. These are some ancillary activities. It is not much important. Therefore, even if some finishing work is pending, still you will be getting the exemption. See, when you are reading exemption now, you should be very liberal. You cannot be very strict with each and everything, that everything has to be completely perfect, then only we will give you exemption. No. Majority investment is already done. Now some tiling work and some flooring work and some electrical work are pending, which is a small portion of the entire house. Therefore, the exemption should be allowed to the SSE. Next one is a very important case. Now, the SSE sold the house for 40 lakh rupees. So 40 lakh rupees he got as a consideration, and 50 lakh is the stamp duty value. Therefore, what will he take as a full value of consideration? He has to take 50 lakh as a full value of consideration. Now the assessee is reinvesting how much? 47 lakh rupees. Now 47 lakh rupees, from where he is investing? 40 lakh only he has received consideration, but he is investing 47 lakh. So the question is, from where he is getting the remaining 7 lakh? The remaining 7 lakh is definitely not from the consideration, that is from his pocket. So can he claim exemption for the remaining 7 lakh also? The answer is yes. While claiming exemption, while claiming exemption under 54F, he has to multiply the amount reinvested as 47 lakh and not as 40 lakh. The assessing officer was saying, no, the remaining 7 lakh has not come out of consideration. It has come from his personal saving. It doesn't matter from where it is coming. Therefore, you will be getting exemption for entire 47 lakh. So whatever is the capital gains, that is 12 lakh, multiplied by amount reinvested, irrespective of the source. Whether the source is the old asset or the source is the personal saving, it doesn't matter. In both the cases, you will be getting the exemption. And one last thing over here, in 54EC, you have to purchase bonds within 6 months. So what do I mean by purchase bonds? If I paid the money and if the bonds are issued beyond 6 months, is that okay? That is okay. If you have paid the money and if the bonds are issued within 6 months or outside the period of 6 months, it doesn't matter. The investment has to be made within 6 months. If you have made the investment within 6 months, you will be eligible to claim exemption under 54EC. The bonds can be issued even after 6 months. That's okay. I hope it is clear to all of you. Let's move to the next part number 10. Sir, what is part number 10? Part number 10 talks about capital gains in case of block of asset. What will happen in case of block of asset? See, always remember, whenever you transfer any block of asset of plant, machinery, furniture, building or intangible asset other than goodwill is not a part of block of asset now. Then in that case, the gain is always short term. Now for that, you need to check the status of the block. If entire block is transferred, it means all the quantities are transferred, then 100% gain or loss will come. Either STCG will come or STCL will come. Always remember, when entire block is transferred, then 100% gain or loss will come. When gain will come? In block of asset, you have to always compare your net consideration with will be compared with opening WDV of the block plus purchases made during the year. If the consideration is more and the opening WDV and purchase is less, then it is STCG. The consideration is more than opening WDV with and purchase. But if the consideration is less and the opening WDV and purchase is more, then it will be called as STCL. Okay. So if the entire block is transferred, 100% gain or loss will come. Now if the entire block is not transferred, in the block there are 10 assets. 8 assets are transferred, 2 are still pending. Now you have to check the amount column. If the amount column is becoming negative, amount column will become negative when the consideration is more than the opening WDV and purchase. If the amount column is becoming negative, then it is STCG, and if the amount column is also positive and the quantity column is also not zero, then in that case you can claim depreciation. I hope it is clear to all of you. We have done all these things in great detail, and you have done all these things in your articleship and in your CA enter also. Now there are some issues over here which I would like to address one by one. First of all, suppose if an asset is destroyed due to fire, if a block of asset is destroyed due to fire, then what is the treatment? The treatment is very simple. Whenever the insurance claim will be received, at that time you should reduce that block of asset, that insurance amount from the block of asset. Okay. Second, what if I am planning to sell my block of asset and I have taken some advance from you and I have forfeited that advance? Rule is simple. If you are planning to sell your block of asset to someone and you have taken some advance from someone and you have forfeited that advance, the rule is simple. If you have forfeited before 2014, then you have to reduce from the WDV of the asset, and if you are forfeiting after 2014, then you have to take it as an income from other source. This is written in point number 2. Third point I have already explained you just now in 54 EC, that is the ACE Builders case law. What is important is the nature of asset and not the nature of gain. Next one is what is reduced from block of asset. Always remember the formula of block of asset in the technical language of the Income Tax Act is opening WDV of the asset plus asset acquired during the previous year minus money payable. It is not using the word sale. It is not using the word sale and all. They are using the word larger phrase, that is money payable. So what is money payable? Money payable means includes any sale, any exchange, any insurance, any salvage, any compensation in respect of asset. Money payable means there has to be some money payable on the asset. If there is no money payable on the asset, it cannot be reduced from the block of asset. For example, I have 10 assets in my block, out of which 2 assets are useless, so I have discarded them. Discarding does not mean money payable. So 2 assets which I have discarded, can I reduce the value from the block? No. Unless and until there is a money payable on it, you cannot reduce that from the block. I hope it is clear to all of you. One last thing over here is Shakti Metal Depot versus CIT 2021 Supreme Court judgment. Here the assessee was making an argument. In the block of asset of assessee, there were some assets which were not used for last 2-3 years for the purpose of business, because it was not much useful in the business, so they were not using. So assessee was making an argument, because the assets are part of block. I agree, the assets are part of block, but we are not using it for the purpose of business and profession. Therefore, these assets which are even though part of block but not used for the purpose of business and profession should be treated as long term. The law says that no. The Supreme Court said that no. The moment an asset is part of a block of asset, whether it is used or does not use, whenever you will sell it, the gain will always be part of block and it will be always STCG. Now you cannot segregate the part of block as some portion which is used as block, that can be STCG, and which is not used, that will be called as LTCG. No, once the asset is forming part of block, it will always be what? It will always be STCG only. There is no question of LTCG now. Okay, so this is what the discussion of block of asset is all about. Let's move on to the next part, that is taxation of demerger now. How demerger is taxed under the income tax law. First of all, what is demerger? Demerger is nothing but a company, say AB Limited, in which there are 2 units, Unit A, Unit B. Now, Unit B is not functioning properly, or there are losses in Unit B, so we are segregating that unit and making it a separate company. So, Unit B will be called as a separate company, will be all the assets and liabilities of Unit B will be given to a separate company, and existing company will be a separate company. The existing company will be called as a demerged company, and the unit which is segregated, that will be called as what? That will be called as a resulting company. Now, what is demerger? The definition of demerger is given under section 219AA. 219AA it is given, where you have to fulfill 6 conditions. First, all the properties of the demerged unit should be given to the resulting company except fictitious assets. Except fictitious assets, all assets should be given to the resulting company. Second, all the liability should also be given to the resulting company. When you give the liability, there can be 2 types of liability in your balance sheet. One which is specific to that demerged unit, give that completely. One which is general liability, give that proportionately. What is the proportion? What is the general liability is of the company which is not dedicated to any particular unit, but that is dedicated to the entire company, that you have to give it in some ratio. What is the ratio? Whatever is the value of asset transferred in demerger divided by total value of the assets before demerger. So what it has to be given in the proportion of the asset transferred. Whatever is the asset transferred divided by total asset, that much liability should also be given to the demerger, to the resulting company. While computing the asset in the numerator and denominator, do not take 2 things. Do not not take revaluation in the numerator and denominator while computing asset, and also do not take fictitious assets in numerator and denominator. I hope it is clear to all of you. Next one, all the properties and liabilities are supposed to be transferred at book value. But if the other person is following not book value but following India's example, then you can value at other than book value also. You can value at market value also, or fair value also, whatever you want to. Then the resulting company. See, the demerged company is giving 1 unit to the resulting company. In exchange, the resulting company has to give something to the shareholders of demerged company, correct? So the resulting company has to give the shares to the demerged company shareholder. So the resulting company will give only shares to the shareholders of demerged company, not any other asset. Okay, then at least 75% of the shareholders in value should participate in this demerger. Like in amalgamation also, there was a criteria of 75%. Here also there is a criteria of 75%. And last but not least, the transfer is of undertaking concern is a going concern. That the undertaking which you are transferring should be a going concern undertaking. It should not be a very old unit. Okay, it should not be a very old unit. It should be a running unit which is transferred under demerger. And last but not least, if there is a demerger of a public sector company, then it is considered to be a deemed demerger. For public sector company getting demerged, all these 6 conditions are not relevant. These 6 conditions are by default fulfilled for a demerger of a public company. Okay, I hope it is clear to all of you. Now, what are the tax implications? Whatever assets are transferred from demerged company to resulting company in the process of demerger is fully exempt under section 47. Only one condition should be fulfilled. The resulting company, that is the recipient company, should be an Indian company. If the resulting company is an Indian company, whatever assets are transferred by demerged company to resulting company is fully exempt under the income tax law. Next, now where are the assets? The assets are in the hands of the resulting company. Now the resulting company is selling the assets. So what will be the cost? The cost will be the cost to the previous owner. Period of holding will be clubbed. I hope it is clear to all of you. Now let's talk from the perspective of the shareholder. What will shareholder do? The shareholder of the demerged company will give their existing shares of the demerged company, and in exchange what they will take 2 shares. So suppose the paid up value of 1 share is today 10 rupees. So the shareholder will give the 10 rupee paid up value share to the company back, and in exchange they will take 2 shares. They will split the 2 shares into 2 companies. They will take new shares in the resulting company, and they will also take reduced paid up value shares in the demerged company. So suppose they are taking new shares in the resulting company and 1 more share they will take, that is reduced shares in the demerged company. If they do so, give share and take 2 shares, then it is also exempt under section 47. Last but not least, now they have 2 shares. One is resulting company share and one is demerged company share. So how this capital gains will be computed now for these 2 shares separately, and how the cost will be computed for these 2 shares separately. So now for that the government has made 49(2)(c) and 49(2)(d). So the law says that the resulting company shares, that is the new company shares, will be computed, cost will be computed as follows. That is the cost of the demerged company share, that is 10 rupee, multiplied by whatever is the net book value of the asset transferred. Net book value of the asset transferred in demerger means net asset minus liability, divided by net worth of the demerger of the demerged company before demerger. It means net worth means what? It means paid up capital of the demerged company before demerger plus general reserve. The definition of net worth is given. So you have to divide the ratio cost of acquisition in the ratio of net book value of asset transferred in the demerger divided by net worth of the company before demerger. Whatever is the value, that will become the cost of the resulting company shares, and the difference amount will become the cost of the demerged company shares. I hope it is clear to all of you. Now there is one Supreme Court judgment of CIT versus KBD Sugars and Distilleries Limited, 2023 Supreme Court. Now what has happened in this case? Can a resulting entity set off and carry for the losses of dysfunctional unit of a demerged unit? And definitely. Suppose the demerged unit is dysfunctional. It is not functioning now, and because there was losses. So can they transfer the losses? Yes, they can carry forward and set off the losses for only balance number of years. As I have told you earlier, that only balance number of years losses can be carried forward. Okay, I hope it is clear to all of you. Now next one, part 12, amalgamation of cooperative bank. Let me tell you how this particular section runs. Suppose there is a cooperative bank which is now getting amalgamated with another cooperative bank, or a cooperative bank which is getting amalgamated with a normal bank. So the amalgamating bank is a cooperative bank, but the amalgamated bank can be 2 types of bank. The amalgamated bank can be cooperative bank also, and the amalgamated bank can be a normal bank also, SBI also, HDFC also. Now what will happen with these 4 expenses? What are these 4 expenses? Section 32 depreciation, Section 35D preliminary expense, 35DD amalgamation expense, 35DDA VRS expense. What will happen with these 4 expenses? The law says that in case of amalgamation of cooperative bank with another cooperative bank or cooperative bank with a bank, these 4 expenses should be apportioned between both of them. Suppose the amalgamation is happening on 25th of December. So from 1st of April till 24th of December, one day prior to the amalgamation, it will be given to the amalgamating cooperative bank, and from 25th December to 31st March, it will be given to the amalgamated cooperative bank. Obviously, in future, it will be given to the amalgamated cooperative bank only. What will happen in the current year? In the current year, you have to segregate between both of them. But this is not what you used to do in case of amalgamation of company. In case of amalgamation of company, now for depreciation, you used to segregate in the current year. But for all other expenses, you used to fully give it to the amalgamated company in the current year. Do you remember that? I have done that interlinking and I have put that interlinking in the bracket. Again, I am saying here all 4 expenses in the current year will be segregated. In future, amalgamated bank will take. In past, amalgamating bank was taking. But in current year, all 4 expenses here will be segregated between both of them. But in case of amalgamation of company, only depreciation was segregated. Rest 3 was directly given complete in the current year to the amalgamated bank. Now let's talk about what? Let's talk about the tax implication. What is the tax implication? All capital assets transferred from amalgamating bank to the amalgamated bank is fully exempt. Then whatever shares are transferred by the shareholder of the amalgamating cooperative bank, and in exchange whatever shares they have taken in the amalgamated bank, that is also exempt. Check it please. That is also exempt. Just like amalgamation, capital asset transfer exempt, share transfer, share taken is also exempt. Now what about losses? For losses, there is a separate section 72A. Here also, whatever losses are there of what? Of amalgamating bank can be transferred to the amalgamated bank for balance number of years, not for another 8 years, and UID can also be transferred. But here there is a catch. For loss now, only amalgamating cooperative bank to cooperative bank losses can be transferred. If there is a amalgamation of cooperative bank to a normal bank, then losses cannot be transferred. See, this provision is applicable for normal bank also and cooperative bank also. Capital gain exemption is also available for normal bank also and cooperative bank also. But this point, this losses point, is only applicable to cooperative bank to cooperative bank. Losses point is not applicable to cooperative bank to normal bank. I hope it is clear to all of you that I have written over here. That amendment they have failed to make 3 years back. Okay, I don't know whether they have deliberately failed or they have mistakenly failed. That I cannot say. That only our beloved finance minister can explain you. Now, part number 13, ESOP. What is an ESOP? ESOP, nothing but sweat equity shares or employee stock option. An employee joins a company. Then the company gives him some condition to stay in the company, say for 3 years. That period will be called as vesting period. Then the company gives an offer. The employee exercises the option, and then the company allots the share. So what is the important date of taxability and when it will be taxable, that we are going to see here now. Pay attention please, all of you. Suppose the employee joins in 2022 and now the company is saying that you have to work in our company for 3 years, then we will offer you an ESOP at a concessional rate. Suppose in June 2025 the company offered the ESOP. In August the employee exercises the option, and in December the company allots the option. So in June it is offered, in August it is exercised, and in December it is allotted. So you have to take the FMV on the date of exercising the option. Suppose the exercising in the FMV on the date of exercising the option is 100 rupees. Which date is relevant? It is June is not relevant, December is not relevant, but August is relevant. The date on which employee exercises the option, that is relevant. On that date, the FMV of one share is 100 rupees. Now you have to compare how much you are paid. You are paying 40 rupees per share. Therefore, 60 rupees will be considered as perquisite taxable in your hand, and it is taxable. So for determining the amount taxable, you have to consider the FMV on the date of exercising the option. Compare with the amount paid. Difference is considered to be taxable. Now when it is taxable? It is taxable on the date on which it is allotted. Taxability will be on the date of allotment, that is in December. So in December it will be taxable. I hope it is clear to all of you. This can also be in 2 different years. So exercise has happened in February, but allotment has happened in May. Therefore, you will take the value of February, but you will pay tax in next year, financial year, in May. Now, later on, when you will sell these shares, what will be the cost? The cost of acquisition of the shares will be 100 rupees, not 40 rupees. The period of holding will be counted from where? The period of holding will be counted from the date of allotment of shares. From December onwards, the period of holding will be counted. I hope it is clear to all of you. So by default, when the income tax will be charged when the shares are allotted in the year of allotment. The value will be of the date of exercising the option. but the taxability is in the year of allotment. I hope it is clear to all of you. Now, there is some deferment of tax for the employees of eligible startup under 80 ISE. If you are an employee of eligible startup 80 ISE, your tax will be computed today only, but it will be deferred to future date. So suppose I am an employee of an eligible startup and I got the shares today in 25-26. So it will be computed today only, but tax will not be taken today. It will be deferred to future date. What is that future date? There are 3 dates which the government has given. Within 14 days from the 3 days, whichever is earlier. Within 14 days from the expiry of 48 months on the end of relevant AY. So in which year it is taxable? It is taxable in previous year 25-26. Therefore, it is assessment year 26-27. Within 4 years from the end of that year is 31st March 2031, and on that 14 days extra. So 14th April 2031 is the first date. Second, within 14 days from the date of sale. So if you sell the shares in 28-29, so whenever you will sell within 14 days from the date of sale, or within 14 days from the date you ceases to be an employee, whichever is earlier. Whichever is earlier, you have to pay the tax. So here you are getting deferment. Your tax is not paid in the year of allotment, but it is paid in the future year. I hope it is clear to all of you. Now next point, extremely important amendment made by Finance Act 2024, for which I have given you great detail in the class itself. That what is the taxability of buyback? I am a company, you are a shareholder. Suppose if I am buying back your shares and paying you 10 lakh rupees, that 10 lakh rupees is your deemed dividend under 222F. From that, you will not get any deduction of any expense, etc. So whatever amount I have purchased from you as a buyback of shares and paid you 10 lakh rupees, that is your deemed income. Plus, if you are a resident shareholder, then I will also deduct TDS at the rate of 10% under section 194. And if you are a non-resident shareholder, then I will deduct TDS under section 195. So buyback has a very simple implication. Buyback is treated as income from other source in the hands of the shareholder. It is as simple as this. So this is income from other source in your hand. Now, second implication, a deemed capital gain calculation. Whatever shares I am buying back, the cost of those shares will become your cost over here, and the sale consideration will always be nil, and therefore this will always be negative, and this you can set off against your other capital gains. For example, you have 10,000 shares which you have purchased for 10 each. Now I am buying back those shares for 10 lakh rupees. So this 10 lakh rupees will be deemed income. Without any deduction on that, 10% TDS will be applicable. But what will happen with this cost of acquisition? This cost of acquisition will be taken over here as 1 lakh rupees, 10,000 into 1. This will always be 0, and this 1 lakh rupees will be allowed as capital loss, long term, short term, as the case may be. You can set off against other capital gains. So 2 heads of income you have to make calculation always when buyback happens. When buyback happens, one calculation will be under IFOS without any deduction, and second calculation will be under capital gains. I hope it is clear to all of you. And one last but not least, taxation of segregated portfolio. Sir, what is segregated portfolio? This is generally applicable to debt mutual funds. Suppose there is a debt mutual fund over here. Debt mutual fund. This is the balance sheet of a debt mutual fund. They have raised 10 lakh rupees from some persons, from investors. 7 lakh is invested in one debt and 3 lakh is invested in another debt. Now this 3 lakh is becoming bad, or the credit rating of this 3 lakh is reducing. So segregate this 3 lakh debt into separate unit. So this 7 lakh will be called as a main portfolio, and this 3 lakh will be called as segregated portfolio, and the company will give you 2 units, one of segregated portfolio, one of main portfolio, just like what demerger. I am not saying much. The cost of acquisition will also be segregated based on the formula of demerger only. There is nothing great in that, and it's not very important also. So this is what my commitment towards my dearest students of full English is getting completed with respect to this chapter, that is capital gains. I hope you all have enjoyed this topic, and I hope you all will continue to watch the lectures live in future also. So till then, take care all of you. Bye. I'll be coming up with the next topic, maybe transfer pricing. Non-resident taxation I've already put for you all. So transfer pricing is the next topic that I'm going to put for you all. Till then, take care all of you. Bye.